Good afternoon. Sorry we're a bit late coming onto this. This is the Accordance Brexit webinar. We've just had a few teething issues technically, but we are here now to hopefully enlighten you about what is going to happen with Brexit. So, sorry, yeah. So the agenda for the webinar today, we will be looking at the current situation with Brexit, about the political context and where that's likely to lead to, looking at then some specific Brexit outcomes. I'm sure everybody's aware there are many of them potentially. And then Brexit's impact on VAT, which is obviously our area of expertise. My colleagues, Andy and Rob Jannering, will be going through in some detail different VAT eventualities, and then we'll also be taking questions at the end of the webinar. So the current state of play, this is going to be, it's me that gets the privilege of talking about where we are with Brexit politically. That's me on the screen. Yeah, so to begin with, happy Brexit Day. Many of you will know that Brexit Day was scheduled for the 29th of March earlier this year. That is hard to believe now. And also hard to believe was that in many parts of the UK, there had been plans for festivities and street parties, bunting. There was going to be unconfined joy. The Prime Minister, Theresa May, assured the House of Commons over 100 times that there would be no delay to Brexit. But as it will not have escaped your attention, the UK remains a member of the European Union. Members of Parliament refused to ratify the withdrawal agreement the Prime Minister had negotiated with the EU, and they also took steps to block any attempt by the government to Brexit with no deal, for now. So the UK has been granted, ironically enough, by the EU, an extension to Article 50, which is the legal mechanism, the 2-year legal mechanism by which the UK ought to be leaving the European Union. And this extension is for 6 months, which sets up a new no-deal cliff edge at the end of October 2019. So Halloween is now the default date for a no-deal Brexit. So why did the UK not depart the European Union on March the 29th? So MPs voted to trigger Article 50 back in 2017, Article 50 being the mechanism by which the UK would leave, which pitted the UK's negotiators against a ticking clock. Most MPs believed that the UK referendum result should be honoured within a 2-year period. But the problem was, as it's turned out, that there was no agreement about what leaving or Brexit actually meant. And all the issues that have been so furiously and internally debated in Parliament, the Irish border being perhaps a central one, but also the customs union, whether membership of the single market would be possible post-Brexit, the right to sign new trade agreements beyond Europe, and the general question of the balance between national sovereignty and the national economic interests. All of these topics remained unsettled controversies and still do remain unsettled controversies. So there was no definition really, no understanding of what Brexit would mean. And as a consequence of that, the more that the Prime Minister insisted that Brexit meant Brexit, which was her rhetoric in the aftermath of the referendum, the more that she tried to assert the strength of the UK's position, the weaker her position eventually became. Because the key question about Brexit, which is how closely economically aligned the UK should be to the EU, had not been resolved. And we now have a situation, and this has developed over a long period of time, where really the conflict seems to be now between a no deal against a no Brexit. That's where the direction of travel is. Hard Brexiteers, the people generally in the European research group around Jacob Rees-Mogg in the Conservative Party, reject the withdrawal agreement that Theresa May negotiated with the EU for not delivering Brexit. They also reject Norway-style EEA-based compromises like Common Market 2.0 or signing up to some form of customs union. But the majority of parliamentarians refuse to countenance a no-deal Brexit, fearing serious economic and social consequences. And you have a situation where the ERG and Nigel Farage as well, with his Brexit party, are desperate to implement what they see as being the true Brexit, which is a kind of almost hyper Thatcherite, low tax, low regulation, Singapore style UK. And they're insisting that no deal is the only authentic possible Brexit. Having insisted, it should be noted throughout the referendum campaign that doing a deal with the EU would be, the easiest trade deal in human history, was how it was described. So the question is, what happens now? And the answer is of course not clear. Sorry, I'm being reminded, before we come to what happens now, we need to ask a question, which is of you. When do you think the UK will leave the EU? Will the UK leave in October, sometime in 2020? Never? Or have you lost interest in this subject through the way it never seems to come to a conclusion? And we're going to see, I think you've got a few seconds. Let's see what the answers are. Never. Oh, a strong show. 48% for never. Coincidentally, is that the 48% of people who voted against Brexit, I wonder? Interesting. Okay. I'm agnostic myself. I hope the nevers are right, but we'll see. So sorry, right, coming on to the next bit. So what happens now? Does the UK feel the fear and do it anyway? That's one possibility. If UK parliamentarians were frightened enough of no deal to enforce the delaying of Brexit in March, there isn't, as far as I can see, any obvious reason why they'd be any braver in October, because for most MPs, given the Halloween theme, Brexit would seem to have a lot more trick than treat about it. But on the other hand, it isn't obvious that well, it's not certain at any rate, whether they could stop it again or what would happen if they did try to stop it. The situation is beyond belief. We don't know what the true positions are of the country's leading political parties. They're making a show at the moment of trying to come to an agreement. By the way, in case you're in any doubt about who the country's leading political parties are, they are alleged to be the Labour and Conservative parties. But nobody's sure whether the negotiations that they're going through at the moment are being held in good faith. I think the parties don't know whether they're in good faith. Will the Conservatives eventually adopt a pro-no deal stance to incapacitate the Brexit party? Will Labour be forced by its members against the will of Mr Corbyn to offer a second referendum on the issue as a whole? We don't know, and we don't know what really is wanted. Now, it's said that much depends on the outcome of the European elections later this month. And one plausible, to me alarming, but plausible scenario is that Boris Johnson takes over from Theresa May in the aftermath of the Conservative Party having a big defeat in the European elections. But even were Mr Johnson to take over as Prime Minister, it isn't obvious how he would force a no-deal exit through Parliament. He might call an election in order to increase his majority, because of course he has the same arithmetical problem that there is at the moment. But if he were to do that, it would risk a Corbyn premiership, or he might even be tempted to offer a second referendum. And this is something that a lot of people believe is becoming more likely, which would be no deal versus Remain. So coming to the next question, to the next poll, which should be appearing on your screens shortly. Yes. Who do you think will win the European elections? And there's not a full spectrum of possibilities, but we've got the Brexit Party, Labour, the Conservatives, the Lib Dems, and there are many others, but these seem to be the main possibilities. And I think you've got a few seconds to state your views on that. 5 seconds. 5 seconds to state your opinion, and then we can have a look. Yes. Deep pessimism. Maybe not. Maybe you would like to see the Brexit Party get this thing done and over the line. But yeah, and interestingly, that actually reflects where the polling is. The Brexit Party is, I think it's currently polling just about 35%. So yeah. So coming into the future then, what do we know? What are the future of Brexit? What are the certainties? Well, one certainty that's, one of the things that's said a lot is that no deal is certain in October. Many commentators have said that, and many of the ERG hard Brexiteers believe that that is the case, that we will just fall out because there will be no alternative. Others believe it's certain that the UK will never leave the EU, and are already talking about an extension to the extension. And what we know for sure is not very much, unfortunately. Still, it's very, very hard to see through the thickets of political conflict at the moment. The only tip I would give is to follow Sir Ivan. Ask Sir Ivan. Not many people have come out of Brexit with their reputation enhanced, but one person who has is Sir Ivan Rogers, and he was formerly the UK's ambassador to the EU, and he's predicted actually pretty much every twist and turn of the negotiations. And that's his book, 9 Lessons in Brexit, is mentioned there. He's also the person that grasped that the no deal WTO proposition really doesn't make sense at its core. And he points out that how can it make sense to want to leave the European Union to be able to strike trade deals with non-European countries, non-EU countries, at the same time as saying that it's acceptable to go to WTO with the EU, who will be the UK's largest trading partner for at least a generation. Now, Sir Ivan believes that however the UK exits the EU, it will have to drastically and quickly amend its current red lines when new negotiations with the EU begins. And the thing I'll leave you on his comment here, because it will have a bearing on the whole debate retrospectively in a way. He believes that in order to protect the UK's service exports to the EU, and remember that the UK's economy is 80% services, the UK will at least partially drop its objection to freedom of movement, which is, of course, one of the big drivers for Brexit in the first place. And now he's been right so far. So that's something I think to look out for. So our last poll question is about what you would like. I think it's just going to appear in a moment. What's your preference for the UK? Would you like the UK to leave the EU with no deal? I think I've done a very bad job at disguising my own prejudice here, but don't let that inhibit you. If that's how you feel, it's a very defensible proposition. Would you prefer that the UK left with a Theresa May's deal, or Theresa May's deal plus a customs union? Should Article 50 be revoked? Could there be a second referendum, or do you just not care? And we're about to find out. I sympathise with the 8%. So let's have a look. So leave no 14%, leave with no deal. That's interesting. So revoke, and for amongst the people following this webinar, revoke and second referendum, the most popular options. Interesting. We shall see what it looks like at the European elections. So that's the context political bit, which I hope has shed some light, though has not shown precisely what's going to happen. And we're now going to move on. And I think, sorry, because we came into this quite quickly. I'm, by the way, the person who was speaking, I'm Nicholas Hallam. I'm the chairman of Accordance. I'm now going to hand over to my colleague has appeared on screen for possible Brexit outcomes. This is Rob Jannering, who's an associate director of the business.
Hi Nick, that's great, thanks for that. So yeah, so political background all discussed. What we're going to do now with myself and with Andy Spencer is just to look at some of the VAT implications of Brexit and what they're going to mean for businesses. And just ahead of that, we're going to talk about what some of the possible Brexit outcomes might be, because there are lots swimming around at the moment, and because all of those influence what the different VA treatments might be. So what does the future look like? Well, one of the options is for a hard Brexit. Another one that really didn't look that popular on the survey just now was Theresa May's deal. There's lots of talk of a customs union, and this seems to be the position of the Labour Party, something they're pushing very heavily. We might have the status quo, so we revoke Article 50 and we remain as we've got it at the moment. Or we might also have a bit of all of the above, because there are conversations going on between Labour and the Tories. There are lots of people with the Oslo model, the Canada plus, and so forth. So what we're going to do here is just have a quick think about what each of these different options might involve, and then we'll think about the more specific VAT impacts of them. So a hard Brexit. So this is probably the more nuclear option, as it were, the clean option that the ERG are certainly pushing. And what this involves is basically the UK will no longer be a member state of the EU, and it will be what we call a third country. So it's no longer privy to any of the EU rules or directives, such as the free movement of people, and so forth. Importantly, from a VAT point of view, it would be outside of the EU VAT area. So we have the EU VAT directive, which applies to all the member states, and then they take that and pass it into national legislation. We would still have our VAT Act, but it wouldn't apply to what is going on with the European VAT Act. And I think also importantly, we wouldn't be part of the customs union anymore. So at the moment, goods can move all around Europe without any duties, and we've all got harmonized standards. In future, we would fall out of that, and we would probably trade on a World Trade Organization basis. So the tariffs are set for us, or there might be some other tariffs put in place, which would apply when goods come in from what remains of the EU 27 and the rest of the world. Theresa May's deal, which nobody seems to like, is not so much, well, it's a bit of a hybrid, basically. So what does it mean? So the deal is basically, it's a way for the UK to exit the EU before we've got a plan in place. And I guess the reason we've got to this situation is that in an ideal world, you would agree what your future relationship with the EU is going to look like, and then you would trigger Article 50, and then you've got the 2 years to decide how are we going to get ready for what the new situation is going to look like. But the UK has done it slightly the other way around. So we are saying we're exiting, and then we'll have a transitional period in which we will try and work out what we're going to do when we get to the end of that. But if we get Theresa May's deal through, and let's remember it's failed 3 times already in the House of Commons, the UK would technically no longer be a member state, so we would have Brexit. But what we'll actually see is that to all intents and purposes, we will be a member state. So even though the European legislation refers to member states and we wouldn't technically be one, we would be treated as such. And that means that all of the arrangements we have as they stand today would continue to be in place until that transitional period ends. So the VAT directive would stay the same, the free trade area would stay the same. And obviously, as it was, the transitional period is meant to end at the end of 2020, so January 2021, we had a new situation. Obviously, the Northern Ireland backstop is getting in the way of that, and we still haven't agreed it. So who knows if that's going to happen or not. The next situation would be to remain, and so that means nothing changes. We would stay within the existing VAT area. We'd continue to be privy to the existing free trade arrangements that we've got, and we would still be talking about those. And then there was one other one as well, which is the customs union. And so the customs union is an interesting one because what it envisages, and none of this has been agreed, but it's what Labour is pushing, is that the UK would actually leave the EU and it would no longer be a member state. And what that means, what we think it would mean, is that it would be outside of the EU VAT area. So again, we're not privy to the EU VAT directive. We've got our own legislation on it. But by virtue of being within a customs area, there would be no duties when goods are moved between the different member states. Now, that's obviously good because you don't have any duties and they're non-recoverable, so it saves you costs. There would be some concessions to make because you'd probably have to keep aligned standards for when the goods are moving. But there's a bit of a clash there with the VAT situation because you wouldn't have imports and exports for customs purposes, but you would do for VAT purposes, subject to there being any changes around it. So that's something that we'll consider. And then obviously there's also, it could be a little bit of all of these in an eventual deal that's thrashed out. We just don't know. What we're going to do now is I'm going to pass over to my colleague, Andy Spencer, who's our Director of Professional Services, and he's going to talk through some of the more specific areas of the impact of Brexit on VAT.
Before I do that, we're going to have another poll question. So what we'd like to do this time is for you to give us an update on how your Brexit preparations have been progressing. What's their current state? So there's a number of options. One is that you're still taking proactive steps to mitigate. Second is that you've paused, waiting to see what's going to happen. Third is that you've not done anything yet. Fourth is that you've had some discussions, but you've got no formal plan in place. And the final one is that you've already implemented your plans as a result of the proposed exit on the 29th of March. So if you give you a couple of seconds to answer those questions. Okay, so we're going to close it now. So interestingly, the sort of the bottom one, which is already rolled out. So we've had this experience with some of our clients who have already implemented because the supply chains were so critical that they couldn't wait, and the potential for us to leave on the 29th of March meant that they had to roll them out. Quite a lot of people are still taking steps, which is good to see. A reasonable number of people aren't doing anything at all yet, and partly this is what we're going to talk about today, whilst others have paused, waiting to see what's going to happen. So there's quite a wide range of answers, but some people that have already implemented. So if we look now at Brexit's impact on VAT, so as Rob has just explained, there's a number of potential situations, but the only thing that we can really comment on at the moment is what's going to happen if there's a hard Brexit. And as Nick explained earlier, we're not entirely sure how it's going to end up, but at the moment we can talk about what happens if there's a no-deal Brexit. So just to be clear, when we talk about hard Brexit, we talk about the UK leaving the EU and no transitional period being in place because Theresa May's withdrawal agreement isn't agreed to by the House of Commons. So that's called a hard Brexit or a clean Brexit, and we're going to talk about what the implications are for businesses in that situation. So as Rob mentioned, we'd be outside the EU VAT area, so it would be a third country. And the key point there is that we'd no longer be subject to the EU VAT directive. That's the directive which determines how member states should apply VAT in their own domestic legislation. Would no longer be subject to that. And instead, the UK's domestic law would take precedent. So the primary UK law is the 1994 VAT Act. There's lots of other statutory instruments in place which determine how VAT is imposed in the UK. Now, at the moment, the way the government has approached it is that they don't want to make significant changes to how UK operates within the UK, how VAT operates within the UK. They want to try and keep it as much as it is at the moment. But what will happen going forwards is that if we're no longer subject to EU VAT law, the UK can make changes to how VAT works in the UK without having to have reference to the EU. So for example, on rates, the UK would have ability to change rates as it wanted to. It could bring new items within the scope of the zero rate. It could increase items much more freely than it could at the moment. And it could also deal with other issues such as specified supplies and exemptions. So there would be much more control. One of the key points in the past was that the UK has often not done things because they weren't able to, but that's often been quite a convenient answer to not making changes which were popular with the public. So that's the legal framework that would be in place. So the UK not wanting to change how we deal with VAT, but the fact that we're no longer within the EU VAT area will force some changes to happen. So we're going to look at goods and services separately, but starting with goods. So at the moment when goods move cross-border, there's a dispatch and an acquisition. That will cease when we leave the EU. So it will return to the pre-1993 situation where you have an export from the country which is sending the goods and an import into the country where the goods are being delivered to. So exactly the same as if goods are imported and exported from outside of the EU at present. So those goods will be subject to import VAT. So that's one of the transactions that's liable to VAT. So VAT would be due when goods enter the UK from the EU and vice versa. So looking at that in some specific scenarios. So initially we'll look at how it applies to B2C goods. So e-commerce sales to private individuals. So at the moment they're subject to the distance selling rules, and the idea behind the distance selling rules is to prevent distortion of competition. So you can't go to one member state with a low VAT rate in order to buy your goods, which would be detrimental to your own country's revenues. So at the moment you register in the other member state if you exceed the distance selling thresholds. Those rules will no longer apply if the goods are being sourced from the UK going into the EU, or if they're being sent from the EU into the UK. So there'll be imports and exports. So it's a need to rethink that supply chain, thinking about who's going to be the importer. So obviously there's a choice between it being the customer or yourself, thinking about what the implications are depending upon who acts as the importer, thinking about whether there's going to be any additional registration needs, because at the moment you've got the distance selling thresholds. So if you are below those thresholds, VAT is due in the member state where the goods are delivered from. If there is no distance selling, those thresholds go. And in most countries, there's no registration threshold for a non-established supplier, so you need to register straight away. And probably one of the most important factors is to think about what the customer experience is going to be like. Because at the moment, the principle of the single market is that goods can be freely moved around the EU, and there might be an obligation for the supplier to account for that at the local rate, but from the customer's point of view, it's the same experience as if they were buying from a local supplier. So thinking about how any changes are going to impact on the customer experience is going to be key in determining what structure you set in place. But the UK has done quite a lot of planning in the run up to the 29th of March. So we know a lot of what's going to happen if there is a hard Brexit in October. It's possible that they'll do more things going forwards because they've obviously got another 4 or 5 months to think about that. But we'll talk now about some of the things that they have done. One of the things they've done is said that they're going to remove low value consignment relief. So that's relief which means that low value goods below £15 aren't subject to VAT if they come into the UK from outside the EU. So the UK has said that's not going to apply any times in the future, so all imports will be liable to VAT. One of the challenges they're going to have is how to collect relatively low amounts of VAT on postal packets, because they need to balance the cost of administration of collecting that VAT with the actual revenue which they're going to generate. So one of the things they've introduced is new legislation and a new scheme in relation to postal imports below £135, which the customer imports. So the VAT is going to be need to paid at the time of import, and that's paid either by the by the supplier registering for VAT with HMRC under a special scheme, or designating the transport company to pay the VAT on their behalf. So it's a totally new way of VAT being accounted for on imports. If the goods are above £135, you need to consider who's going to be the importer. So if the supplier is the importer of record, they'll need to be VAT registered. If the customer imports, they're going to have to pay the VAT on import. And that's comes back to the point about, well, what's the customer experience like? If they have to pay VAT, how are we going to achieve that? Do we want to make it easy for the customer to pay to enable them to have a more positive customer journey? So important decisions to be made and details understood on what the implications are. So looking at it the other way around, if goods are going from the UK into the EU, so the EU are temporarily retaining their low value consignment relief values. So if the customer imports and it's below that threshold, there's no VAT or duty to consider. Each country can apply their own thresholds, so they vary slightly depending upon where the goods are going to be. But if they're above the figure and the supplier is the importer, there's an immediate need to register for VAT in order to deal with the onward supply of the goods in the local country. So in that scenario, you can recover the VAT that you pay on import, but you then have to account for VAT on the local sale of the goods. So that's B2C. So we'll now have a look at the impact for B2B transactions. So again, there's two aspects to look at. One is from the sale, and then the other is the import, so the export and the import. The export of the goods, if it's going from the UK to the EU, can be zero rated. You just need to have evidence that the goods have moved. There'll be no acquisition tax to account for by the customer, but VAT is still going to be due on that transaction. So VAT will be due on the import. And that's the key factor which needs to be taken into consideration. And that will be determined by Incoterms. So what Incoterm is in place, and the Incoterms are there to determine the responsibilities of both the exporter and the importer. So it'll be necessary to think about what Incoterms you've got in place. Are they appropriate, and do they then lead to any subsequent implications for you if you're the importer of record into another country? Obviously, as well as the VAT implications, there's also the customs implications, because there'll be need for customs declaration, so there'll be more documentation to be produced, which will increase costs, and also the potential for there to be delays when goods are moving through customs, because at the moment there's no documentation at all and goods can move freely within the single market. So as I've said, it's critical to decide if the supplier or the recipient, if it is the importer. If it's the supplier, then depending upon the value of the goods, and this is where if the goods are delivered a postal packet, which is where they're below £135, if they're coming into the UK from the EU, the VAT would be due under the postal package regulations, even though it's a B2B transaction. So need to be thinking about whether that applies to some of the goods that you sell. If it's the recipient that's going to import the goods, is that going to be commercially acceptable to them? Incoterms can be silent within the EU because in the past it's not, certainly from a VAT and a duty point of view, it's not been important. But do you need to change the Incoterms that you've got in place? For example, if you've always worked on DDP, there's commercially no impact historically, but going forwards that will be very, very different. One of the other announcements that the UK's made is in relation to postponed accounting. So the VAT that's due when goods are imported into the UK. At the moment, you have to pay that VAT, although you can defer it using a duty deferment account. But going forwards, customs have said that they will allow that to be postponed to the VAT return for the import VAT. So there'll be no physical need to pay any VAT when goods are imported, and that applies to goods both from the EU and also from outside the EU. So that's a welcome facilitation measure which will improve cash flow if there is a hard Brexit. Okay, then finally, looking at from a goods perspective, goods going into the EU, so all imports will be subject to VAT. Again, you need to consider who's the importer of record. If you're the supplier, do you have to register in that country? Because it will be dependent upon how the that country applies the extended reverse charge for B2B supplies of goods. Some countries it's easier to import than other. In the same way as the UK has got postponed accounting for import VAT, other countries have got similar mechanisms, but the rules that apply can be different. So depending upon where the goods are imported to, there will potentially be a different process in place. And again, there'll also be customs documentation, and if we're outside of the customs union, there would be duties as well. So that's finished on the goods side of things. So I'll pass you back to Rob, who's now going to look at the impact on services.
Okay, thanks for that, Andy. That was really useful. So services, well, I think the first thing to say about services is really that compared to what Andy's just talked about for goods, the impact is going to be less pronounced. And the reason for that is that when you have B2B services, certainly they're subject to what we call a general rule, and that means that VAT is due where the customer belongs, and definitely within the EU and for a lot of other countries around the world. That VAT is then accounted for by the customer doing a reverse charge, which is really good simplification because it means the supplier doesn't need to get registrations in lots of different countries. So if we do have a hard Brexit, we don't expect there to be a sudden need to have lots more registrations. And so likewise for UK businesses receiving services from outside of the UK, they will just do a reverse charge continuous as currently the place. There are some exceptions to that, such as supplies connected with removable property, some work on goods and emissions to events. And so, for example, if you are selling tickets to go to an event somewhere within the EU member states, it still remains that VAT is due where that event takes place, and you will still need to get a registration. But really, you need to look at these on a case-by-case basis to just understand what is the VAT treatment of my supplies, and do I need to have another registration somewhere? So whether there's a hard Brexit or not, you should continue the normal process of just understanding your transactions and making a decision on what's needed to be done. B2C services, again, there will be little change to what's going to happen, but I guess one real important bit to flag is for suppliers of electronic services. So a little while ago, at the start of 2015, feels quite a long time ago really now, the rules were changed in the EU, and for people who did the electronic services, so such as music downloads or apps, the VAT became due where the customer belonged. Now that might have created a need for all of those businesses to register where the customers were. So the EU created what is known as the mini one-stop shop. And so for a UK business, they can register with HMRC's MOS. And if they owe VAT from France or Spain or Germany or anywhere else, they can account for the VAT through that MOS. It's a really good simplification. If there's a hard Brexit, then for any UK suppliers, they will still be able to use a MOS, but they will have to swap to what's called the non-union MOS. So they would have to pick an EU member state, and they would have to go to that member state and say, please, can I apply for your non-union MOS? And they would have to account for all of the VAT through that system. So practically, there wouldn't be too many differences once they'd made the change, but there definitely had to be a plan to get a new registration in place and think about the processes behind accounting for it. The next thing to think about really would be fiscal representation. So this is something we've definitely helped a lot of our clients with. And fiscal representation is basically, it's a rule that some member states have put in whereby they say that if you're a business that's from outside of the member states, they will give you a VAT registration number, but they also want that VAT number to be associated with a fiscal rep. And the reason they do this is that it's much more difficult for a tax authority to go and find a business that's not paying its taxes that is belonging outside of the EU. So the fiscal rep, because it's associated with the business, is got a fixed point within the member state, And what you will often find is that the fiscal rep will take on joint and several liability with the business, so that if the business doesn't pay its taxes or doesn't file its returns, the tax authority in the member state can go to the fiscal representative and say, I want the money from you. Now, that's a good thing for the tax authority, but what it does mean is that to use a fiscal representative, you normally need to lodge a guarantee with them. So this might be an amount of cash that is equal to the amount of VAT payable, or some member states, the tax authority dictates the level of payment to be made as well. But that guarantee is needed, so in case the business does disappear, the fiscal representative isn't left out of pocket. And there are also sometimes higher costs associated with that as well, because the fiscal representative likes to do additional due diligence checks before submitting VAT returns, because obviously they are joint and severally liable for it. I think what's important to note is that not every single EU member state does this. So Germany doesn't have the need for fiscal reps, just like the UK doesn't at the moment. We have seen certain countries within the EU who have got the requirements say they're going to impose it on UK businesses. So Belgium is a country that jumps out immediately. But then there's some others like France who have said, well, the UK, we're okay with that. UK businesses won't need fiscal representation. So I think the key thing to be aware of is that if you've already got VAT registrations in the EU and we have a hard Brexit, it's a really good idea to do a sense check around all those registrations and say, do I need a fiscal rep in place? And if you do, think about putting it in place and thinking about time to do that as well. The next point to be thinking about is VAT recovery. So VAT recovery is whereby you incur VAT in another member state, but you can't recover it via the normal method of a VAT return because you've got no need to be VAT registered or you don't have an establishment there. Now, at the moment, most businesses within the EU, so if a UK business incurs French VAT, they will use what's called the refund directive. And the refund directive allows the claim to be made to HMRC. HMRC pass the claim over to the French tax authority. The French tax authority deal with it, and then they pass it back to HMRC for refunding. If we have a hard Brexit, UK businesses won't be able to use that refund directive to make the claims, and the same will go for businesses in the member states, won't be able to use the refund directive to make claims from the UK. UK businesses will have to use what's called the 13th directive, and the reason we're flagging this is that it is a much more burdensome and time-consuming activity to do it. So, for example, you have to make the claims directly to the other tax authorities. That means that you normally have to correspond with them in local languages. You normally have to provide all of the original invoices to the tax authorities, which under the existing system you don't have to do. And also there are much quicker timeframes as well in which to make those claims. So really, it's really important that if you are making refund directive claims at the moment and we've got a hard Brexit, there's a real need to get prepared and understand what the changes might be. One of the things you can do is put your claims in now, so ahead of any Brexit taking place. That's a really good thing to fail safe against it. Otherwise, I think there's probably a big question mark around, can you make those claims? And there might be VAT costs lost in the future. And then the final thing we wanted to flag was around just some other considerations. One of them was triangulation. So this is another simplification, but lots of businesses moving goods across Europe rely on it. It's used where you have three parties in a chain transaction, but the goods go directly from the supplier to the end customer. And normally what that means is that the parties in the middle of that supply chain have to be registered in the member state where the goods arrive or the member state where the goods are delivered from. But triangulation avoids that, because if the supplier the intermediary and the final customer are all in different EU member states, and they've all got different EU VAT numbers from those countries, you can avoid the need to be registered in the different countries. So really efficient triangulation to mitigate the need for registrations. But if we have a hard Brexit, all of those businesses who use their UK VAT number to facilitate triangulation, that won't be possible anymore, and they'll have to rethink how they account for the VAT on all of those supplies. So another situation there to look at. And then the other thing to think about is, well, EC sales lists and Intrastat declarations, these are returns that detail the supplies made between different EU member states. They can cover goods and they can cover services. We expect that where you have UK to EU supplies taking place, these will fall away. So that is good news in a way, because it's less declarations to file. But at the same time, we're carefully monitoring whether something else is going to come along and replace them. So I guess those are some of the real considerations to think about of the impact that Brexit might have on VAT. What we want to just ask now is for one last question. And so just thinking about what we've talked about, can you let us know what you're most concerned about in the event of a hard Brexit? So a couple of options there. Is it more VAT registrations, fiscal rep, not being able to recover VAT on costs from abroad, customers having a bad experience like Andy was talking about, or duty costs that are irrecoverable, not being able to get them back? So I'll just give you another 10 seconds or so. I know that just give you a bit of time to read them and put an answer in. I'll give five more seconds if anyone's got any more answers. Okay, let's see what the answers were. I'll put those results up on the screen. So I think that's interesting. So not a VAT issue as such, but duty costs being incurred. And I think that's a really sensible thing to be worried about, because they are obviously irrecoverable and they hit the bottom line of the P&L account. And then after that, it looks fairly even across the customer experience, the fiscal rep, the need for more VAT registrations. I think what that probably shows is that there's just lots of different things to be worried about, and managing Brexit really isn't going to be that easy. So that brings us almost to the end of the session. We're going to have a Q&A just at the end. But just to sort of wrap up what we've been saying, so like Andy mentioned and Nick, we've been helping lots of clients with Brexit so far. And so we're just thinking about what the next steps might be. There's definitely a bit of lethargy around Brexit, and it's been going on for so long, and there's so many different options. And with the deadlines passing, some people are obviously pausing a little bit. But we think it's still really important to be making plans for Brexit, because things are likely to happen very quickly. So some of the things businesses should really be doing at the moment is probably mapping all their supply chains, because this will help you understand where goods are moving, where services are, and who the customers are. And then you can help determine what the impact of a hard Brexit might be on those. It will give a chance to think about contingency plans and solutions to the problems that are found, because if you need fiscal reps, then you need to get that registration in place, and that could take 6 to 8 or 12 weeks. If you need to put guarantees in place, there will be a need for cash, so you might need to go and ask your treasury or for bank loans to be put in place. And I think the most important thing at the bottom there is just to have a continuous review and being aware of what's happening with Brexit. We are going to be putting updates on our website, so people know what's happening politically and what that then means from a VAT perspective. And obviously we're here to talk to people about situations as and when they like. So that wraps up the technical bit of it. And obviously we've got here any questions. So there is a Q&A system on the webinar. We've got a few questions coming through. So if anyone wants to ask any questions, please do so. There's one question that's come in here, which is will event supplies such as giveaways for exhibition stands be subject to import tax and VAT when arriving in the EU? And if they're not going to come and subject to getting it back into the UK if not used on site. So that is a really good question, because this is where you've got the goods going into the EU, and some of them will be given away for no income, and then some of them will be brought back to the UK as well, and you're probably not aware of what that situation is at the outset. I think when the goods do go into the EU, it's very likely that there will be some duty costs on them, and that will depend on the value and what the commodity code of the goods are. Normally, though, if you take goods into Europe and then you bring them back out again, there are some reliefs available, so you don't have to pay the duty and any import VAT. But those reliefs are very specific as to how they work. So it'd be a case of definitely looking at that in a little bit more detail and understanding exactly what's happening. Okay. So, Andy, have you got any questions that have come up?
There's a few questions in relation to reverse charge. So the reverse charge in relation to services, as Rob was explaining, that still continues in essentially the same way as it does at the moment. So if you've got a B2B supply of general services, so something, for example, like consultancy or legal advice, the VAT is due in the country where the customer is established, and it's accounted for by the customer applying the reverse charge. So we had another question in relation to about when the new B2C import rules are going to be effective. So that is, and the question was it is a fixed date or is it subject to Brexit? It is going to be subject to Brexit. So whenever there is a hard Brexit, or we formally leave the EU and are no longer considered to be a member state for VAT purposes, those new rules will come into place. Until then, the existing rules in relation to distance selling for intra-EU supplies will apply, and if the goods are coming in from out of the EU, the current rules will apply. So that solution is only going to be implemented if there is, in the event of a hard Brexit. We've also been asked about why do we think the UK law from '94 will be reintroduced again? Effectively, that's always in place. So the EU directive sets out the legal provisions on an EU-wide basis, and each member state then has to implement it into their domestic legislation. And the way that the UK done it, the primary UK legislation dates back to 1994. So there will be no change. That's effectively already in place.
Okay, we've got another question asking, when will the new B2C import rules become effective? Oh, sorry, Andy's answered that one. I've scrolled to the wrong bit. Here's another question. Will VAT be paid on consignment sales in the member state, as well as VAT on the import into the UK from outside the EU? I think in terms of imports into the UK, well, anything coming from anywhere in the world will be subject to import VAT, and it will be, that will just happen as a matter of fact under the rules that Andy explained. In terms of whether you incur VAT in a member state in the first place, that will really depend on the contractual terms that you've got in place and whether the supplier can put an exemption to its supply of the goods. So normally, if say a supplier in France was selling something to a UK business and they knew the goods were going to leave France, they could exempt the supply, so no VAT would be charged. But depending on how that transaction is going to take place, so is the UK buyer going to collect the goods? Has the supplier got the evidence to support the exemption? There may or may not be local VAT charged. So we will have to wait and see and look at the details of each transaction in time. There's another question here. Do you know if we'll be able to apply for an ORI number before October the 31st in the case of a hard Brexit? Because we know we can't have two numbers in the EU. That's a really good question, and we've dealt with that on a few occasions now. In short, it's right, you should only have one ORI number. But what we found is some member states are being quite helpful in terms of allowing businesses to plan to get a new ORI number. So lots of businesses in the UK will have a UK ORI number, and the Dutch tax authority, for example, they are allowing UK businesses to obtain a Dutch ORI number, but they will accept the application, and they will tell you that a number's been given, but what they won't do is put the number, make it go live and give you all the details around it. They will basically put it on hold, and the moment that a hard Brexit is going to happen, that number will be released and it will be active to be used. So depending on where you want the other ORI number, there's the opportunity to be able to put some contingency measures in place.